The first thing that we need to understand is the nature of the original mortgage note, which will have a face value, an origination date, and a term and amortization term, which will give it, therefore, a maturity date. The next thing to understand is what is the initial borrower default date. And default can be either a missed payment, a late payment, or a partial payment. And we'll need to know the date that that first default occurred and what the nature of that default was. When we know the month at which the amortization stopped, we can then solve for the unpaid principal balance at that point simply by looking to the amortization schedule for the original note. Next, we need to understand what is the total cost to us, the purchaser of the note, in terms of how many cents on the dollar are we going to pay, and if we are going to use debt for the acquisition of that note, what will the loan to value of that new debt be relative to the note purchase price. And then naturally we'll need to account for all the transaction costs that are going to accompany purchasing the note, such as legal and any loan origination costs